Hello and welcome back to The Note. Well, it's been a wild and weary week on world markets. There's been a clear overarching narrative, but a surprising number of stocks and sectors that have departed from that narrative. Now, the big story is that concerns over growth have intensified, largely thanks to China, while sentiment over rates here in the US has shifted after many Fed governors have spoken, finally including Janet Yellen herself on Thursday. They seem to have convinced the markets that there was an overreaction to last week's decision not to raise rates and that we should brace ourselves very possibly indeed for a rate rise before the end of this year, most likely in December. Now that has translated overall, because of the concerns over growth, into a bad week for stocks, but there have been many exceptions. This is not an indiscriminate sell-off. If you want to take a look at perhaps the most dramatic example here in the States, there is great concern suddenly about healthcare and in particular pharmaceuticals, the big star sector of the year. We've had a very embarrassing story for the sector about Turing buying a drug and immediately jacking up its prices very dramatically. And you have seen a very, very sharp sell-off in pharmaceutical stocks. As you can see, compared to the index, they're now barely ahead of the market at all for the year. That's partly because of the Turing story. It's also because a lot of portfolio managers are getting nervous as they see the overall pattern of the year as the end of the year approaches, and they're more inclined to take profits while they still have profits. If we take a look at this next chart, you can see an even more dramatic example of this going on in Europe. We had, of course, the Volkswagen scandal, discovering that they were cheating on their emissions tests. That led to a huge sell-off for Volkswagen and the auto sector in general as people tried to digest the ramifications of what had happened. It could yet actually have macroeconomic implications for the Eurozone. For the time being, it has led to a very sharp sell-off in auto stocks. Now, it's possible, and I think quite reasonable in some ways, to put a positive gloss on this. Until you had the pharmaceuticals sell-off this afternoon here in the States, you saw a very positive reaction to Janet Yellen's speech. You saw stock markets in Europe up more than 3%. Most stocks here in the US were up. Bond yields plainly suggested that people thought that a rate rise was back on the table, even if Fed funds futures told a slightly different story. It has to be positive, I think, that the market was more pleased to hear that Janet Yellen thought that there was some growth around rather than worried by the prospect of a rate rise. It's also quite encouraging, given how much stocks tend to have moved in unison over the last few years, to see some discrimination re-entering the market. As for what comes next, we have the turn of the month next week. That means we'll get a welter of new economic data, most importantly on Friday, unemployment data here from the US. And then we should look forward to reporting season for third quarter earnings. I suspect that could be the most critical element in determining whether the correction, the sharp sell-off of the last few weeks turns into a true bear market or whether it stays as merely a correction.